Hi, this is Kim Watson. In this video I am going to cover understanding risk. It's a subject that I get asked lots and lots of questions on it. This is part one. In a sense it should probably be part three, but the risk on, risk off is where I get so many questions, so I thought I'd answer those first and then we'll look at other elements of risk within trading in upcoming videos. So, as soon as you say risk on, risk off, you immediately think of the Karate Kid and wax on, wax off. But it's nothing to do with that, but, well, maybe. What it's actually meant by it, simply put, is when traders are happy and buoyant in terms of what's going on in the economy, they'll generally take more risk. Some yields would be falling. So it almost makes them look for more risk to make the same sort of money. So they're sort of driven towards risk. As things get a little uneasy, they come away from those because they don't want to be caught. So the risk comes off. So it's simple as that. Risk on means that traders are willing to take the risk. Risk off means traders are not willing to take the risk. And I'm talking about the bigger money. Retail traders, well, they can create some volatility, and we've seen it to a degree within the crypto markets. But even that said, that some of the bigger ones probably just are sitting still on that, so they're not making a big reaction. But we've seen with Bitcoin, for example, we've seen that sort of state of extreme fear a few times, and it's still sitting in a fearful sort of mode. So how do the markets react? Well, I'm actually going to go through the markets in a moment, so I'm going to come on to that in a short while. But basically, they react as we would expect in terms of the bigger markets, such as the indices dropping on the risk off and going up on risk on, but I'll go through that in a moment. What can cause it? Uncertainty. Uncertainty is the biggest thing there. We can see before a big Fed meeting, for example, potential risk coming off a little bit as traders are uncertain which way the meeting might go. At certain times they get a bit ahead of themselves, but in the main the risk comes off a little bit, and it can increase volatility in the market, but it can also, as I said, we'll look at the markets and how they react. We'll see some each one effect has a counter reaction, so we can look at that. So uncertainty really causes it. Things such as the Ukraine war that's going on as I record this, that caused massive uncertainty. And then as soon as there was speculation that there may be peace talks, then the risk came back on again. So the risk came off on the basis of the war starting, and sort of unexpected but expected, and then it went back on as traders saw the messages in terms of peace talks. As soon as that happened, it started turning it around a little bit. Now it's in this uncertain area as we look at the moment. What can you do about it? Well, I'll give you the guide here and you can make a decisions up. You can look for what's actually happening within that market. When the risk basically comes off, we see the dollar bought, and if the dollar's bought, most other currencies are selling. The bond markets are bought, so bonds are bought, and you'll see yields falling. If you're looking at yield charts, you'll see yields coming off as bonds are being bought. Equities are generally sold as risky, and commodities, some commodities are sold. I say except gold and silver, but even gold and silver can take a shot at times, but generally gold is seen as sort of a safety, and silver will follow up close behind. But likes of oil will generally get sold, obviously not in the situation with Russia and Ukraine, but it's gone quite the opposite. But there's the reaction to a market and a potential shortage, so it's a different type of risk. The yen or euro can be bought at times. We've seen actually quite the opposite with the euro. It depends on what the risk is more so. The yen is it's seen as a safety area. I've said the yen and also the Swissy. The Swiss dollar, of course, I've missed out on, which is a key currency which a lot of traders will buy into for safety. more so than the euro, of course. But the euro also has its time when it gets bought as the second biggest currency out there. If it's more American bias news, then the euro may see a slightly bit bigger benefit. Commodity currencies, on the other hand, like the Aussie dollar, the Canadian dollar, they're more likely, not the Aussie CAD, but the Australian and Canadian dollar, and New Zealand dollar. I should put that on there as well. Those commodity currencies generally sold. So that's the risk off, where the risk runs from. It runs in towards the dollar, into some of the safety, the yen, the Swissy, maybe the euro, and runs out of the other currencies. And it's quite the opposite. When the risk comes on, the dollar's sold more, the money goes wider, bonds are sold, yields start rising, and equities are generally bought as it's back to normal. Commodities are bought except for gold and silver, which might be just dropping back down again. The yen tends to get sold. Now we're seeing that at the moment, and the Swissy will get sold to a degree. So we'll see these currencies get sold. I had the euro down here as being bought when things were going bad. It doesn't always get sold when things are getting good, but its impact may be less. Commodity currencies, I've got here sold, they're actually bought. So commodity currencies are actually bought. The Aussie and the CAD, they become more popular, and some of the pairings like the Aussie, Euro CAD, that they can make some good movements in such a case as the Aussie and CAD retake their place, even if they're not quite so strong against the US dollar. So there you go. That is risk on, risk off. Looking at the reaction, how can you benefit from it? Carefully, I would say, because just as easy as the risk goes off, it can come back on. And when the markets get particularly risk on, risk off, we saw it with Trump when Trump was running for re-election, etc., and we saw things. It was almost like an every other day we saw something react. It may be just as easy to do take your risk off and not be trading. So a lot of people don't think this is a right way to be, of course, because I'm a trader, but reduce your risk, and well, that'll be a subject of another video on risk, but reduce it. Maybe reacting the opposite way. Obviously, look at what happens when the risk comes off on the big money, but be careful. As I say, you can get real quick snapbacks on those. In fact, let's just have a look at some charts, if I can just bring the chart up, and we just sort of see some reaction recently. So let's just go to a daily chart. There we go. So there was the beginning of the war. This is oil, Western Texas. Well, there was normally we'd have seen oil being sold, but we saw oil rally. It went the other way, and then as talks proceeded, oil started running downwards. But this is a supply and demand problem that's caused around it. At the same time, the euro at that really took a big hit and sold off. It's a surefire sell for a long time. Seen a bit of a bounce. Now we're in this uncertain area, so it's sort of the risk is back on a bit, and it might come back up some more. But the euro for sure isn't having a lot of fun. The risk for such an Aussie dollar, it was doing pretty well beforehand, got sold off pretty strongly, but it took an amazing bounce back up here, and it's really running pretty well here. So you can see where it's really gained over the other markets there. And if you look at the Aussie dollar against some of its peers, and this is what I said, look at it against the yen, for example, and well, we didn't get too much reaction on the sell side. The yen was in this case, on this particular occasion, was being sold along with the others. The baby went out with the bathwater, but the Aussie actually, it's since that period, although it did stalled back here, and it stalled into the early stages here, it started selling off. It has recovered extremely well, but it's making haywire commodities again. It's a demand-led bit of price action going on here. So you shouldn't forget supply demand and how it may affect the other markets, of course. If I can just switch really quickly onto the equity markets, I'm going to pop them on here. We'll look at the S&Ps, for example, and the S&Ps were already in a downward direction, but they dropped quite quickly, and as risk is sort of, and they sold again after a bit of a bounce there, but as risk is suddenly coming back on into the markets, we're seeing this rally, so that's working quite well. Looking at the yields in terms of bonds, yeah, so bonds didn't take quite such a hit, but in fact the yields continued pushing in on this occasion a bit, but it's certainly since then they've been pushing back up. There's the money's coming back in, and bonds are being sold, so the yields increase. Okay, that is it for this video. I'll have a whole series of the risk videos. If you want to make sure you get those, please subscribe to my channel. Also, really appreciate a like if you like this type of video. Have a great trading week, month, and the rest of your year. Take care.